Hey everyone, welcome back to Corporate Decoder. Today we're going to decode something truly unactive. We've got a filing from a company that is literally just getting started, and by just getting started we mean they haven't report you'll ever see in your life. Before we dive into this exciting saga of inactivity, if you love breaking down these dense corporate reports into plain English, make sure you hit that subscribe button. Also, we have a super active Discord community where we discuss company filings and much more, so definitely check that link in the description below. So, what are we looking at today? It's a quarterly report from the Cotwo Advisors Physical European Carbon Allowance Trust. Now that sounds fancy, right? European carbon allowances. That's basically like a permit to pollute, or rather a permit to emit greenhouse gases like carbon dioxide. Think of it like a special token the companies need to have to cover their pollution. But here's the kicker with this report. The period it covers is up to May 2025, and guess what? The trust hadn't even started its real business yet. Seriously, the report explicitly states multiple times that the fund had not commenced operations as of May 31st, 2025. It hadn't started investing, it hadn't issued any shares, and it hadn't bought or sold any carbon allowances. It's like getting a report card for a student who hasn't attended a single class yet. Let's look at the financials. Under assets, we see investments in European Union carbon emission allowances, EUAs, at fair value cost 0.00, and cash is also 0. Total assets, 0. Shares issued and outstanding, 0. Net asset value per share. You guessed it, 0. It's all zeros, folks. Not a single dollar invested, not a single allowance held. Now for the operations, under investment income, it's 0. Under expenses, sponsor fees are 0. Net investment income or loss per share, you're seeing a pattern here, it's 0. Every single line item related to financial performance is just zilch. It's a blank slate. And that makes sense because, as the report states, the trust hadn't really begun its journey. The report covers a period from late April to the end of May. And during that time, what happened? Well, the registration statement for the trust was declared effective by the SEC. That's like getting your learner's permit. They're also telling us that operations actually began later, on June 17th, 2025, with shares starting to trade on NYSE Arca on June 20th, 2025. So this report is essentially a snapshot of the company before it even opened its doors. The main takeaway here is that this filing is purely procedural, demonstrating that they are complying with SEC requirements even before their business is operational. It's like filing the paperwork to form a company, but the company itself hasn't hired anyone or made any products yet. The sponsor, Cotwo Advisors LLC, is essentially doing all the legwork here. They arranged for the trust creation, the registration, the listing, and importantly, they covered the initial costs. They also mentioned that the trust is offering an indeterminate amount of securities. This usually means they haven't decided yet how many shares they want to offer, which is typical for a new fund. The core idea behind this trust is to track the performance of these European carbon allowances, or EUAs. These are valuable permits in the European Union system for controlling greenhouse gas emissions. The EU has a cap and trade system, meaning there's a limit, a cap on how much pollution companies can emit. If they emit more, they need to buy allowances. If they emit less, they can sell their unused allowances. If they emit less, they can sell their unused allowances. If they emit less, they can sell their unused allowances. The price of these EUAs is influenced by a ton of things: the economy, government policies on climate change, technological advancements in reducing emissions, and even how mild or severe the weather is, because that affects energy demand. It's quite a complex market. The filing also touches on how they value these EUAs. They use the daily settlement price for futures contracts on EUAs traded on ICE index markets. This is a pretty standard way to get a fair value for these kinds of assets. They classify these investments as level 2 assets according to accounting standards, which means their value is based on observable market data, but not direct prices in an active market for identical assets. Think of it as using similar products' prices to figure out the value. Now, even though there are no financial numbers to really analyze in terms of performance, because again, nothing has happened yet, we can look at the intent and structure. The sponsor gets a fee, which is 0.79% of the trust's net asset value. This fee covers all the operational and administrative expenses, which is pretty convenient for the trust itself. This means the sponsor bears the initial costs and then gets compensated through this management fee once the trust starts generating value. So what's my take on this? From a financial perspective, this report is a big fat zero. It's a look at a company before it's even begun to do anything. The story here isn't about financial performance, but about the foundational steps of launching a financial product. It's about regulatory compliance and setting up the structure for future operations. The key risks as outlined in the filing are all related to the underlying market for EUAs. Things like political and economic events, new technologies that might reduce the need for emissions trading, and the very effectiveness and continuation of cap and trade systems themselves. If the EU decides to change its approach to carbon emissions, or if new, cleaner technologies make these allowances less relevant, the value of the trust could be significantly impacted. The company's direction is clearly focused on capitalizing on the growing market for carbon emissions trading. Its strategy relies heavily on the continued relevance and stability of the EU ETS. The strength here is the clear defined objective to track the price of EUIs. The weakness, or rather the current state, is its complete lack of operational history and actual investment activity. In terms of opportunities, if the EU carbon market continues to grow and prove effective, the trust could see significant appreciation in the value of its holdings. The risk, however, is that regulatory changes or market shifts could diminish the value of these allowances or even make the entire trading system obsolete. My conclusion is that this filing is more of a placeholder, a necessary administrative step. To truly evaluate this trust, we'll need to see future reports once it's actually operational and has begun investing. Right now, it's all potential and no performance. Alright, that's our breakdown of the Cotwo Advisors Physical European Carbon Allowance Trust's pre-launch filing. What do you think about betting on the carbon market? Does this $0 report make you curious about what they'll do next? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up. It really channels more content like this your way. And don't forget to subscribe for more corporate deep dives. You can also join our Discord community from the link in the description. Thanks for watching, and we'll see you in the next one.